All right, I think let's just make a start. And then if anyone has any questions anyway, you can unmute yourself and ask me questions, or if you're too shy to speak, please send questions across as and when you think you have something. I will be sharing my contact details at the end of this webinar anyway. So if you need to reach out and book an appointment to discuss further, we can do that as well separately. Right. So let's just get started. Welcome to the Real Estate Tax Mastery. I am Lavleen Gandhi. I'm going to be your presenter today. This has been brought to you by Infinite Experts Proprietary Limited and our partners Real Money, NIDUS Group, H2O, and Aman Lawyers Proprietary Limited. Our focus is to equip you with the key insights and strategies for effective real estate tax management. Let's get started. So before we move on, sorry, there's like a technical glitch again. Just going to share that. We're going to start with the acknowledgement of the country. So we respectfully acknowledge the traditional custodians of the land across Australia, honoring their enduring connection to land, sea, and community. We will honor our elders. We pay homage to the elders past and present, and extend our respect to all Aboriginal and Torres Strait Islander people today. In the spirit of reconciliation, we commit to building respectful relationships and understanding across all communities we serve. So before we proceed, I'll just give you a brief introduction about myself. So I started off and I came in Australia in 2012 as an international student. I've got a lot of qualifications, but just the main ones to focus on is Bachelor of Business. I've also got a chartered accountancy degree. I'm a registered tax agent, and I've done various other financial courses. My future plan is to pursue financial advisory certification, and I'm also planning to do a chartered tax advisory course from a tax institute. I've been practicing since 2016. I started off in a big corporate firm, and then I went to small boutique firms as well. So I've got experience with small to medium-sized businesses. I've worked with high net worth individuals. I've worked with mom and dad companies, and the largest client that I've looked at is with someone that has had $100 million in their asset and have been publicly listed as well. So my aim is to provide you with a comprehensive solution for focusing on wealth and finance and also tax. So my goal is not to just look at your taxation side of things, but also to provide your financial wealth building technique as well, so you can get a holistic approach in your financial well-being. So just giving a disclaimer here, I can only provide you with general financial advice at this stage because I'm not a registered financial advisor yet. I am a registered tax agent, however, so if you do have any questions around taxation, I can offer you legal advice as well. Please note all solutions are tailored to everybody's needs, so everybody's finances are different. So if you have any questions at any stage, please book in a consultation or maybe just speak to your own accountant if that's what you prefer. So let's get started. I want to try and simplify your financial solution journey together. Okay, so the objectives of today the objective of today's webinar is basically to focus on property investment. So what I will be doing is I'll be crafting a financial advice for someone who is just beginning into property investment. So they would have a salary of $70,000 or more, and they might have a deposit or will be saving towards their deposit over a couple of years. I will also be speaking about first home buyer support. So there are multiple schemes and grants and concessions, and if there's any tax implications, I'll be covering those topics as well. What we will also be focusing on is understanding negative gearing. Now, this is a question that I generally get asked a lot, especially for someone who is planning to rent out a property. They normally want to understand what negative gearing would mean for them, if that's a good thing or a bad thing, and how that will impact on your taxes as well. I will also be focusing on what sort of deductions you can claim if you do have rental income. And we can also speak about capital gains tax. So what that means for you. So what that means, what it does, how it affects your taxes, etc. We will touch base on investment structures as well. And then apart from that, we will also focus on which is the right structure for you. So the last bit about choosing the right structure, this is more tailored advice for your situation. So if you do want to know what sort of structure you want to get into, please get in touch with us and we can book in a meeting and discuss further. So main thing that we'll be focusing on is empowering your first step into property investment or any other investment with clarity and confidence. Okay, so the paths to get started towards property investment is obviously first you need to start building your financial foundation. Let's assume that you do not have any savings as of now. So the first thing what you need to start doing is basically start saving. Make sure that you are cutting down all your unnecessary expenses and start saving as much as you can. If you do have any credit cards or if you have any loans, try to clear that off as much as possible, because this is something that any banks or lenders would check whether you have any outstanding liability or not. The next thing would be, just once you're ready with your savings and everything else, you need to understand if you have any benefits or any other grants that you can actually access. So look at the time of what sort of grants that are available if you're a first time buyer, and also check whether you can actually reside in that property as well, because it does come in with the condition of living in that property. The next thing is obviously try to also boost your income while you're trying to save. So you could consider putting your savings into crypto stocks, or maybe start a drop shipping business or any other business that you think you can do in addition to your job. Also, what I always tell my clients as well is basically start budgeting. So try to allocate funds for savings and guilt-free indulgences as well. So that's also inspired by Ramit Sethi. So if you want to understand that more, you can always look at Ramit Sethi's videos and start budgeting for anything that you like to spend on. Could be eating out or shopping or whatever it may be. Then in addition to that, you can also try to manage your earnings. You can ask your employer in advance to give your salary, do a split salary system. Ask them to put in the money separately for your saving and spending account. And what I always do is, if I have a savings account, I only use that for investment purposes or emergency. So if you can start implementing the same thing for yourself, it could be useful. So the main thing is, if you do have a disciplined approach for savings, then obviously a gateway to any sort of investment, not just property, is just it's easily achievable and accessible. Okay, so I've actually built a case study again for a fictional client who has about $70,000 worth of annual salary or more. The assumption is that this person is single, lives in a shared accommodation, has no car, has no debt, and is only getting started. So the main thing is, he's got a salary. Don't focus on any other numbers. Just focus on something that is in bold over here. So the main thing is the gross salary is $70,000 and net salary is $55,000. So that's your take away of salary that you would receive in your bank account. So you've got $55,383 over there. And then you have other expenses that sum up to total of $25,600. So if you, very simply, if you just minimize these expenses, so as much as you can minimize your expenses, you will have more savings, right? So obviously rent is something that you cannot ignore. Utilities and bills is something you can't ignore. Travel is essential. Groceries is essential. The only thing that you can actually focus is on entertainment or any other indulgences that you might have. If you can minimize that, great. If not, that's up to you. In this scenario, we've just allocated about $100 per month for the entertainment, with which this person is able to save about $29,783 annually. Now, the next step would be, you've got your $29,783. Obviously, that's happened over a course of one entire year. What can you do with the savings? You can obviously put that under your savings account, with which you'll get about 1% return. So you've got $297 right there. You can also put that in ETF investments, where you can approximately get 7% returns. With this, you'll be making about 1,600 yearly. And then you also have cryptocurrency. Now, this is a very risky investment. As long as you understand what crypto is all about and understand the market and you know what to do with it, that's when I would suggest to get into a cryptocurrency investment. At this stage, I've actually assumed that it's about 25%, which is obviously on the lower end, where this person has been able to earn 5,833 over the course of a year. And then he also has an option to get into an e-commerce business. Now, usually I've got clients in e-commerce businesses, and the average monthly income that I normally see as a profit is $2,000. So depending on you, if you know what you're doing with your business, you can obviously grow this out further. So again, now this comes down to your decision factor and your risk tolerance. So you need to understand what your tolerance is. If it's high, then maybe you can go for cryptocurrency or e-commerce, or you can go for something, that is low risk, which is, your savings account or maybe ETFs. So it's crucial again for higher risk investment to understand what it entails. Probably some more planning and some more training and understanding and education would be knowledge, like would be an advantage for something like cryptocurrency or maybe shares and stock. Your financial goals you need to understand and figure out what is the best thing for you. Are you looking for a short-term gain or a long-term gain? So it's very important for you to look at those aspects and make a decision as to where you would like to invest as well. So once you've done all of this, or this person decides what his risk appetite is, he can then decide whether savings account is better for him or maybe cryptocurrency. Does anybody have any questions, or am I going too fast for anyone? Please feel free to ask questions if you have anything up until here.
I have a question, Lovely.
Sure.
Looking at the savings account returns at 1%
Yeah.
versus ETF, which is 7%, why is a lot of people aren't going to the ETF like your clients? Because I understand that you have a big client base.
Yeah.
And even in my circles, when I talk to people, I don't see like a lot of people actually going
For ETF.
for ETF.
Yeah, I actually agree with that. I think there's a lack of knowledge.
It's like safe plus 7% return as well.
Yeah. Sorry, Karam, you were breaking there. Yeah, I agree. Actually, most of my clients are reluctant with ETF. I think it's only because they just do not have enough knowledge around ETF investments. And this is obviously subject to market risk as well at the end of the day still. So they're still using these investments, and if the market is performing, they'll get a good, decent return. But in case it's not performing, it can obviously drop. So it's just the fact that like they just don't know what to do with ETFs, and maybe they just need a bit more education towards it. And that's the reason why they're not too comfortable using ETF investments. That's my understanding. What do you think? Like, what have your clients come up with, and you've had a chat with them? What was their excuse?
Look, in my interactions, people in the like post 50 years old group, they have a good understanding. And even I think, in my opinion, younger people should look into it for saving for ETF. I personally use ComSec, but I wanted to ask you, like, you have a preferred platform.
I personally like the bigger banks as well. So I would use ComSec myself because it's a lot more safer. There are a lot of other platforms, but I think it's always good to check whether they have the right, license, and whether it's a safer investment or not. So you might have to just check if it's chess licensed or not. So I personally prefer the bigger banks because it's a lot more safer, and you know that you will mostly get this money back as well.
By the way, this is not a sponsored content from ComSec. We're not getting paid anything from ComSec.
Yeah, I agree. I think ComSec or NAV or maybe even Westpac, I would be okay with that.
Okay, that's all from me. Anyone else want to ask a question? I think I made everyone available to talk.
Is there any minimum or maximum amount we can do for ETF, or it's like whatever amount we want to do, we can go for it?
I haven't seen any minimum or maximum amount, so it completely is up to your discretion. So you can always get started with the most minimum amount as well.
Manisha, I've seen people doing like with $500 as well. But the magic is like you put a direct debit and then just keep on adding, like, for example, monthly allocation of $250, $500 as minimum, or more if you like.
Okay, it's more like SIP. Okay.
Yes.
Yeah.
Any other questions? I guess if not, you can always pop in your questions, and we'll just continue for now. Okay. All right. So after you've decided where to put your money, and let's assume that now you're ready with your deposit money and savings, etc. You're getting closer to checking what sort of grants are available. Right. So what I would recommend, obviously, checking these sort of grants and schemes from time to time, because it does change every year. Some of it just starts changing towards, mid-year as well. Like, for example, First Home Super Saver Scheme, we're expecting a change in September 24. So if you are using the scheme, just double check what might happen after September 24, whether you can access it or what has changed as well. So to begin with, we also have first home owner grant. Now, each state has a different grant that is accessible. It's a one-time payment that you will receive from the government, whichever state you're in. And the amount could be $10,000 up to $30,000, depending again which state you're in. This amount that you receive is tax-free. So it's a great way to basically use this money as a deposit for your first home buyer scheme. The second thing that is available is stamp duty concession. Now, this is more tailored towards what is the value of the property that you buy. So there could be, like, for example, in New South Wales, you could buy a property up to 800,000, which is a house, and you will pay absolutely no stamp duty upfront. So that is a great way to save money, and it reduces that barrier to entry towards that property investment as well. So it's a good one to look at as well. There is first home loan deposit scheme. Now, this is a bit of a mix where you can also come in as in, like, the government can help you as an equity share where they can own up to 30 to 40% of the house, or you can actually step in with a very low minimum deposit starting from 2% to 5%. So there are different types of first home loan deposit schemes. So if you'd like to know more, you can always arrange a meeting with any one of us and we can assist you and check whether you're eligible for this scheme at all. First home super saver scheme, this is for everyone. It's not just limited to Australian permanent residents or citizens. So even if you're a temporary resident or a student, you can already start contributing towards your super. So this gives you an advantage of already preparing, for your property investment when you're ready. You can also get a tax deduction if you're doing voluntary super contributions. Maximum contributions you can do in a year is $15,000. And the maximum you'd be able to draw as of now before September 24 is $50,000. So $50,000 as a max. So any withdrawals, because obviously when you're putting money into super, you're getting tax benefit. So obviously when you will be drawing that money out, you may have a tax liability. So just letting you know about the new schemes and concessions. If you have any questions around this, you can always ask me right now as well. If not, I'm happy to move on from here.
Has the maximum super contribution gone to 30K now, or is it still 27.5 per year?
So the concessional contribution, is that what you're talking about?
Yeah, for maximum contribution for an individual.
Yeah, so the maximum that you can claim as a tax benefit is $27,500, and without claiming a tax benefit, you can also put in $110,000 per year as an individual. So if you'd like to claim a tax benefit of $27,500, that includes your mandatory super that you receive from the employer, which is known as super guarantee. And if you've done any person super contributions, you can claim that up to $27,500 as well.
But if you put like 110,000, there's no tax discount or anything like that.
No, that is all after tax, so there is no tax benefit. But if you've contributed, say, about 110, you can draw out 50,000 as a max as a part of the scheme. So you can use that $50,000 towards the home deposit if you don't have a house.
Okay.
Okay. Any other questions, guys?
Sorry, just a question from me that I get a lot of from my clients when they're looking to buy an SMSF property.
Yeah.
For example, if they've got $100,000 in their SMSF and they're looking to purchase a property for 500, it will mean that they've got the deposit, but the stamp duty isn't enough, and they've already made their contribution for the year, which is 27,500, we just discussed. What happens if, let's say, they are $20,000 short? Can they sort of put money in advance in the super with the tax benefit, or is there something of an option, or not really?
So there is something that is known as carry forward concession contributions. So what that means is you can, if you haven't used up the cap value of 27,500 at all over the 5 years. So say the first year you put in 10,000, next year you put in 20,000, and then the remainder years you were using the cap benefit of 27,500. I'm just giving you an example. So the first year you still have 17,500 to claim, and you can use that additional money towards your super and claim that as a tax benefit as well. So you can still use that concessional contribution over the 5 years if you haven't used the entire cap. If you have crossed the cap completely, like say you've utilized that 27,500 in full, you can put in non-concessional contributions, which doesn't give you any tax benefit, but you can use that towards buying a property in your super fund. Does
Right.
that answer your question?
Yes, so we can go as far as 5 years from
Yes.
and whatever has been not like as in not being utilized, they can put as much amount up until the 5-year mark.
Exactly.
Okay, and if they still have like they don't have anything left over, then they can still put something, but it won't be tax benefit or tax deduction or something on it, right?
Yeah, so they can use up to 110,000 per year as a non-contribution.
Perfect. Thank you very much.
Not a problem. Anything else? Anybody has any other questions? Okay. All right. So we'll just move on for now. So again, this is relating towards the same thing. Just if you do have a benefit from the government, just do check it if you're a first home buyer. These grants and concessions mostly can be tax-free, except for the first home super saver scheme. So there is a tax liability that can happen when you do draw that money out. It also helps in reducing your upfront costs. So they're like, you're saving money, especially around that the stamp duty concession. That helps you saving approximately 30 to 40,000, depending on the value of the house that you're buying. The next thing would be just try and understand what these grants can be used for. Try and get off as much as you can and use these concessions to make your first house more affordable as well, right? If you need any assistance in determining your eligibility for any of these benefits, please feel free to reach out to any one of us. We've got Aman from H2O Loans, we've got Karam from NIDUS, and I'm also here. And we've also got a solicitor from Aman Lawyers. You can approach any one of us and we're more than happy to help you out with this. Okay, so let's assume now the client, the fictional client that I was talking about, who has $70,000 in salary and 1 year saving, has decided to go with the savings option, which is generally what I've seen. And that's what Karam was talking about as well. Nobody really opts for ETF. So with that $29,783, he's got an interest of $297. And then in addition to that, because he's a first home buyer, he's also received a $10,000 grant from the government. So the total deposit here he has is about 40,000. Now the maximum value of the house that he can go up to is 400,000, because you do need a 10% deposit in order to get started. This is assuming that he's not eligible for any other grants in this scenario. Because the value of this house is less than 800,000, and let's assume this person is from Greater Sydney. In that case, he doesn't have to pay any stamp duty upfront, so that is $0. He may, however, need to be prepared for any other associated costs. So there could be some lawyer fees or building and pest inspection or any other sort of random expenses that might come towards his way. So just be prepared with those sort of expenses, and also be prepared that the repayment as of the current market would be around 25,194, assuming that the loan that he's taken is about 359,000, and we're assuming that the interest rate would be about 7%. Obviously, if the interest rate does drop, then the repayments would reduce. So this is only covering the repayment section. Please bear in mind, obviously, this person is going to be living in this house. There would be other expenses like council rates, water rates, etc., that I haven't accounted for over here. So they need to be prepared for those sort of expenses as well. The next thing is, okay, we've bought the house. Now, what is the next thing you can do if you've bought the house? So the very first thing is you need to make sure if you've got the grant, you need to live in that house for at least a year to comply with the grant conditions. After the first year is completed, it is completely your choice if you'd like to rent it out or continue living in it. Now, if this was me in this person's place, because he's single and has no dependents, it's probably best for him to rent this property out, because he's spending more money living in this property, because just the repayments itself is costing him about 25,939 each year. Whereas renting anywhere else in a shared accommodation, he would be spending about $15,000 a year. So that's like easily about $10,000 worth of savings. Not to mention, obviously, the council rates and water rates, etc., that he would have to pay living in this property. The benefits of renting out would be, obviously, it can assist you with your mortgage repayments and other expenses as well. And if you are renting out, there could be some negative gearing that you can access. So if the property has any expenses, especially if the expenses are higher than the income, then there's negative gearing, or just simply to put it, there could be some losses that can be used towards your taxable income that'll help in reducing your taxable income, and it will help you saving tax money, and you can utilize that money again to reinvest, probably pay off your property. I'll discuss more about negative gearing shortly. I'll give you an example as well on that. Does anyone have any questions yet over here? If I'm going too fast, please let me know. Okay, if not, then we'll move on. So this is something I've already discussed in the previous slide. So we're just going to move on. So what I've done here is I've created a rental income schedule. So this is something if this person decides to rent out, what he can expect in the current market. So I've assumed that the rent that he's receiving is around 10%, which is pretty great. So he's receiving about $400 each week, which sums up to about 20,800. And then I've allocated some expenses here. So now total expenses sums up to be about 41,270, which is higher than the income that he's received. So this loss over here is known as negative gearing, basically. So what we do with negative gearing is basically we use it as a financial leverage to reduce the taxable income. Now with this, what I'll do is I'm also going to share an Excel spreadsheet, which will be a bit more better in explaining. Can everybody see the Excel spreadsheet right now? Can you guys see it?
Yes.
Okay, perfect. So what I've done is I've shown something that is the rental loss is basically your negative gearing. So this is your rental loss and there's no rental loss. And I'm just going to show you the difference between it. So let's assume this person has the same salary. So $70,000. His taxes that the employer pays on his behalf is about 14,617 because he was putting his money into savings. I've assumed that he's had the savings of 297 that is taxable as well. And we've rounded up some other deductions could comprise of car expenses, home office, etc. That is about $8,000. Now the rental loss with the same schedule that I just showed you was about 20,470. Now, what happens in this scenario is because of the rental loss, his taxable income, which is basically salary plus interest income minus deductions plus the rental loss, works out to be about 41,000. Versus if he had no rental loss, let's just remove this for a second. Let's assume he's not renting out as of now. So what happens is basically if he did not have a rental loss, he would be having a taxable income of 62,000. Now, there's two interesting things that actually happen over here. The current resident tax rates as per this is basically if you fall under this margin, you'll be paying taxes at 32.5%. Okay. So here, as you can see, this person is currently getting a refund of 2,722. Now, versus this loss has not only helped him save taxes at 32.5%, which basically this is at 19%. Let's just change that. That would have worked out to be about 6,652 worth of tax savings. Plus, in addition to that, his tax bracket has also changed. From 32.5%, it's dropped down to 19%. So that itself is giving him another 13% worth of tax savings by switching over the taxable income. So obviously now his tax refund has boosted. He's getting nearly $10,000 worth of refund. So just happy days. He can use this money towards putting it towards the principal of the property, or if he's got an offset account, he can use that. Now, going offset account, if you haven't gone through the webinar that Justin, I think, had done on, as well as Aman, where they explain what offset account means. We can explain that to you very quickly because we do have someone from loans over here who can explain it to you. But if you put that money towards your offset account, what that effectively means is you're paying less interest and you're paying towards your principal more. And that means you're going to create more equity that can be used as a form of refinancing. And you can basically use that again to reinvest into your properties as well. Is that making sense? Does anyone have any questions, or am I going too fast over here?
It does make sense to me, but in terms of the media coverage of a lot of people when they're advising, especially from tax community or accounting based community, don't buy properties, negative gearing. But based on your spreadsheet, it makes more sense to buy properties with negative gearing. But another thing we can add here, one is tax advantage, plus when the property price growth happens. So it's a double whammy in a way for the homeowner.
Exactly. So if obviously the value of the property is growing, that means you can use that equity like basically buy another house without paying a deposit upfront. You can refinance and utilize that equity to again buy another property and keep building that property portfolio. Obviously, I think you can explain that better than I can. We do have a loan specialist as well on board, but yes, I'm more than happy to collaborate with you in explaining if anybody has more questions around that as of now.
But do you advise in your practice to the clients for properties with negative gearing?
It depends on I normally advise most of my clients to, especially the ones that are high net worth or having a very high salary or income. It is a great tool to basically reduce their taxes. There are some talks right now that the legislation may change and maybe there could be a potential, there won't be any tax savings maybe in the future, but it hasn't been passed yet. So quite likely it may or may not happen. So as of now, we still actually do tell clients to buy properties with negative gearing to reduce their taxes for sure. But in addition to that, it's not just about reducing taxes. I also focus on financial wealth. So if it's going to help you, leverage off, and if that property is going to grow in capital, I think you should look at it as a holistic approach, not just focus on whether this is going to give you tax savings or not, but also look at whether this is going to give you capital growth and can you actually use that growth or that equity towards buying more properties as well. Tax is also obviously a part of it. It does play a major role, but we will obviously try to minimize your taxes in other ways as well, if possible.
So I know we're in real estate mode at the moment. The same formula, does it apply to crypto losses or share market losses?
No, crypto losses are a bit different. So it depends it just depends how heavy trader you are. So some crypto traders, maybe if they are trading about say 4,000, 5,000 cryptos a day, then maybe we can utilize their losses to, offset their taxable income and reduce their taxable income. But if they are not heavy traders as such, then it's more of a capital gains tax situation. So the losses cannot be utilized to reduce their taxable income. But you can use those losses maybe in the future in case you do have a gain. It will help you reducing your future gains as well. So it's a bit different. So it just depends on the treatment and depends on how heavily you're trading into these assets as well, in order for us to assess whether it's a capital gains tax or if it's a profit and loss sort of scenario.
And share market?
Share market can be similar as well. So it just comes down to if you are a stock trader or not. So if you're trading in this day in, day out, then we do trade it, we can trade it as a profit or a loss situation as well. But if you do not do heavy trading, you're just simply investing, to just make some gains, then you can't really utilize those losses with your normal income. It will only be used towards any assets that you probably sold in the future and have had gains towards that to reduce the gains for those particular assets, if that makes sense.
Gains.
Yeah, I can give you an example with the property. This is again now towards the property side. But if, for example, if this was a share sort of portfolio, then we would be treating the losses exactly how we've used the rental losses, where someone is heavily trading. If they've got losses, we can actually utilize those losses. But if they are not heavily trading, the way we would utilize their losses would be towards a CGT sort of scenario. So what happens is, for example, year one, I'm just going to create a new table. So year one, say you've had a gain of $10,000. Okay. This is with your crypto or shares. Okay. Year two, you've had a loss of maybe $5,000. And year three, you've had a gain of maybe $7,000. Okay, I'm just throwing in random numbers here. So year one, you're definitely going to get taxed, and this is under the CGT method. Okay, so with CGT, if you've held the asset for more than a year or more, then you can get, under individual structure, you may get about 50% discount on the gain that you make. So we'll assume as of now, these are all short-term trades and there's no discount given. So say this person is paying, 32.5% of taxes on this amount. So this is the tax amount they'll end up paying. Sorry, I think there's an additional zero. just fix that up. On this loss, the second year loss, because it's a loss, you don't pay any taxes under CGT method. What happens with this loss is it gets carried forward in year 3. Okay. So in year 3, so there's no taxes over here. And in year 3, the tax that you would be paying is not on 7,000 directly, but it would be used as an offset method. So here you've got a profit of $2,000. That's what we're going to do. And then let's assume that your, tax bracket is again 32.5%. So we'll just use that. So you're, instead of paying taxes at 7,000, which would have been, say, 2,275, you've saved money and you're just paying taxes at $650 instead. Does that make sense?
Yeah. So in a nutshell,
Yeah.
Out of all the 3 asset categories, the more benefit for taxation is with the property, isn't it? For entry level.
For entry level, definitely. Like if you don't know what you're doing and you're looking for a safer investment, I personally like real asset more than shares, because shares and cryptos are so volatile. You just don't know. You might be making a lot of profit because it's riskier, but it can just drop and you might lose everything that you've got as well. So in comparison to property where you've actually got something tangible, it's a lot more safer. You'll get a fixed return or maybe more depending again on market, performance as well. But at least you're not going to lose money. The land value normally does appreciate. You do have that capital growth that is ongoing. You've got your rental income maybe that you can use, and that loss, if in case you're having losses, obviously that's a tax advantage as well that you can utilize as well.
And building is insured as well.
Building is insured as well. So you're basically protected from all aspects.
Yeah.
Okay.
Thank you.
Not a problem. All right. So I'm just going to go back to the same presentation that we were on. So negative gearing is explained. Does anybody have any questions over here for negative gearing? Okay. Probably not. So let's move on. So now let's assume that this person has moved out, has rented out the property, and now it's been almost 5 years since he's rented out the property. So what's happened in these 5 years is this person has a salary increase of about $100,000 per annum. The value of the property, I'm being conservative here, has only increased by $100,000 as well. He's paid off his interest, which is the additional $10,000 he was getting, from the tax refund. He's been putting it towards his offset account or maybe putting it directly under his loan account. And he's paid off, say, approximately $50,000 in addition. So now what can he do next? So normally, if you are, and this is the current tax legislation, so in case it changes in the future, I don't know, but current tax legislation states that if you move out of your principal place of residence and you do not have any other house that you live in, you can have an investment property, but no other house that you've lived in. You can move into your first property again and renew the 6-year mark again. So basically you can, if you plan not to sell it, I would advise move back into the property within 6 years and basically extend the tax-free selling window. And then again, after a year, you can move out and you can keep repeating that whole cycle or that whole process again and again till you decide to sell this property. So what that does for you is basically it helps you save any tax that you may pay in the future because it's still considered to be your primary place of residence. You can, in the meantime, if there is growth in that property, you can always refinance, you can always leverage off that property, and you can use that equity to invest in more properties as well, or use it for other investment purposes as well. Does anyone have any questions over here? No. Okay, so let's assume this person decides to sell, okay, and this is within the 6 years time frame. So see, I'll explain you what that means. So if this person decides to sell, what might happen is there could be something that is known as capital gains tax might occur. So that happens usually if you sell or swap, if you're using crypto or shares, if you want to swap coins, you can, that would trigger a capital gains tax event as well. Or if you'd like to transfer it into a different structure as well, that would also entail a capital gains tax event. How this is calculated, it just depends on what the structure is of the person. So if it's an individual, the tax that you pay would be depending on what sort of tax bracket you're sitting on. If it's a company, then maybe it's around 25 to 30%, depending again what sort of company you're in, and if there's any active or passive income involved. If you're in a trust, again, that could be different, and partnership could be different. So we can help you calculate that if you're in that sort of scenario. If this is your primary place of residence, which means that you don't have any other house except for the same house that you bought, then you can basically get an exemption from that sale that might happen in that future. So you would not be paying any taxes over here in that scenario. And the main thing is you need to understand how you can, I would probably plan it especially if you're a primary place of residence owner. I would plan it better and make sure that I keep renewing my primary place of residence in order to gain that exemption, because there's no point paying taxes if you don't have any other properties. Anybody has any questions over here?
I do.
Yeah.
So this is capital gains free time.
This is capital gains tax free time.
Frame is available if you don't have if you didn't buy another property and moved in.
That's right. You can buy another property, but as long as you did not move into it and did not claim another primary place of residence, then that's what the main thing is. So you can have maybe 10 investment properties and one primary place of residence that you've held from the start. And what I would do is I would check which one is going to have the most gain and use that as a leverage tool and make that as a primary place of residence. That would be my take on it.
So if you had first house, you bought and you made it as an investment property, now it's rented out, you've moved into another property, which is you bought it again, for example, you've upgraded as well after your first home. Now, between the both, you assess, okay, which one is going to grow more in value, you make that one as a primary residence.
That's the way I would go, yes. And also, you say if you held the first property for say a couple of years and you bought a second property after the second year, the first couple of years for that first property, you would not pay capital gains tax. But after the second year, because you now have a different property, there could be a capital gains tax implication for the first property. And I'll explain that to you again on Excel. I think there's a question as well that I can see. Just a second. Okay, so from Elijah, so do you have to pay capital gains tax if the coin or token is transferred to a cold wallet? If it is your same wallet and you haven't swapped it, no, there's nothing that you need to pay over there. Does that answer your question? And the second question is, I want to ask the question about buying and selling property as permanent resident or citizenship residence condition tax-wise. So buying and selling a property as a citizenship resident condition, can you elaborate on this? You can always buy a property. There could be some basically grants that are available, and selling the property again, if it's just your first house, then there would be no capital gains tax. So there's no tax that you would have to pay if you sell that property and if you've been living in that property, if that makes sense again. So not a problem. 190992, do you have any other question? Would you like to elaborate more on your question, or is that it?
I think in my view, there's no difference between PR and
citizenship.
Citizen,
Yeah. There is a new regulation saying if you are not living for more than 200 days.
Oh, yes. Then I believe you're classified as a foreign resident, isn't it?
No, but if you are not living in Australia, then you're not a permanent resident or a resident at all. So if you are living in Australia and you're a permanent resident, then there is no tax implications. But if you're a non-resident, then the tax implications could be completely different. But this was specifically around PR or citizenship residence. Is that right? If it's a non-resident, you might, or if you're a foreign citizen, then you might have to. Would you like to speak 190992? Do you want to just unmute and maybe have a chat? Would that be better?
What I asked you is about, there's a new regulation. One of my clients actually sold his house in Australia, and he is a citizenship. He's not a PR, but because always living overseas, and he got the charge for, and the tax office has withhold about 120,000. So I was quite confused, and then I did a little bit of research, and it was saying that if you are living overseas and you are permanent resident or citizenship, as long as you're not living continuously for more than 200 days a year in Australia or something like that, otherwise you get charged for, the capital gain as what I call the foreigner capital gains. Like, when same as when you're buying, you pay extra amount of money as well.
Yeah, so that's right. So you need to be in Australia in order to get an exemption. It's treated like very differently, like if you're not onshore. So what your client has actually received is accurate. Like we cannot change his circumstances. Unfortunately, that's what it is. We can't really do anything about it. If you are onshore, however, there is an exemption that is available. Or if he was onshore, then he would be paying. If he was entitled to capital gains tax, he would be paying resident rates as well. Does that answer your question? Do you have anything else to ask?
No, that's all.
Yeah.
Yeah, I just want to
Really,
double check. Is that clear to clarify?
Yeah.
That's all. Yeah, thank you.
Yeah, not a problem. Okay, so if you don't have any other questions, sorry, do you have any other questions as well?
No, all good.
Okay, perfect. I'll just move on then. All right, so let's assume in this case, what I'll do again, I'm just going to share my screen and we'll talk about capital gains tax in detail. So let's assume this person has decided to sell, but it's been more than 6 years. So what has happened in this scenario is we've assumed that he's bought the property for 400,000. This was in year 2020. He rented out in the market for 450,000. He rented out in the market, and at that point in time, the value of the property was 450,000, and he decided to sell in 25. Okay, so we've assumed that it's been more than 6 years that he has used the property, like he held the property for, but he did not decide to move into the property at all. And in that case scenario, what we've done is basically come up with a capital gains tax calculation. So in this scenario, what happens is usually we don't consider the value of the property as at the time that he bought it for. We get a market valuation done and check when it became an investment property. So instead of using 400,000 as the value or the cost base of the property, we decide to use this amount because it was a lot more higher. So this can be done through we can always contact a qualified valuer to find out what the valuation was when this person moved out and it became investment property. So based on this, the gain becomes 200,000, right? Instead of it being 250,000. And because he's held the asset for more than a year, he can get a discount of 50%, which works out to be about 100,000. Now, based on his current salary, 70,000, and also, by the way, it became 100,000, my bad, because we decided the value of his salary has gone up. So it's 100,000 salary. Assume that his tax withholding on 100,000 is about 20,000, and the capital gains tax of 100,000 as well. And then he's also got interest. Again, we've assumed that similar interest amount is there. And we've got the similar amount of deductions and rental loss as well. So based on this, he'll be paying taxes not at 32.5% because his taxable income has become around this range. It'll be 37%. Okay. So in that case, he's going to be paying taxes at a higher rate with the capital gains tax versus if he actually sold it less than 6 years, or if he would have moved in to renew this amount, there would have been no capital gains tax implications at all. So this mainly just tells us it's so important to plan or be a bit more proactive about planning when you're planning to sell it as well. That way you can save a lot in taxes. Does anybody have any questions over here based on this? I guess not. Okay, so we'll just move on again and just go back. If you have any questions around capital gains tax or you're in that similar situation, just deciding whether you should sell or not, just feel free to reach out again. Okay, so same thing. After 6 years, there could be capital gains tax. If there's any calculation, we're more than happy to calculate it for you. And if there is a possibility of market valuation that will help in capital gains tax, reducing the capital gains tax implication, more than happy to discuss that further with you guys. So with the next slide is basically just around the ownership structures. You can decide to buy a property under an individual, partnership, company, or trust. So if you're planning to get a grant, I don't think you're allowed to buy it under any other structure. You can only go in for an individual structure. But if you do have more than one property and would like to decide what structure is best for you, it's best to probably just give us a call and we can organize a meeting and decide which is the best structure that will help you maximize tax savings. and also provide you with some asset protection as well at the same time. But the main thing to consider here out of all of this is a self-managed super fund. So not a lot of people know, but you can decide to manage your own super fund and utilize that for future investments in properties, crypto, shares, or whichever. Like you can also buy gold, or you can also buy overseas assets. So maybe that is something that is interesting to cover. My next seminar would be like based on what structure, like probably just pick up on each structure and like dive more into it. We'll consider what sort of decisions you need to make in order to like decide which structure is best for you. However, whatever advice I'm giving is more general in nature, so it's best for you to like just give us a call and just have a chat. Generally speaking, I would never recommend a company structure for property investment or any long-term investments, only because there's no 50% discount available under that structure. But if you have any questions, or if you already have an asset under the company, you can always give us a call and like we can discuss further on how to mitigate those capital gains tax issues as well. So if you don't have any other questions, thank you so much for the time. But if you have any questions, I'm more than happy to speak to you right now and answer it, or we can arrange a time and meeting to discuss further just around your own financial criteria.
Are you able to share your details, Loveleen?
Yeah, I'll share my details. I'm gonna send it off to everyone. So just again on the chat, I'll be sending these presentation slides as well as a calculation tool along with my card and my contact details. So everybody will receive it in their email if they've registered with us. So I think that should be good enough. And if, just keep a copy of these notes and some calculation tools for budgeting, etc. as well.
All right. Any other questions for real estate or finance people? I'm gonna allow everyone to speak. If not, we would like to say good night to everyone and thank you very much for being part of it. Thank you again, Loveleen. It was really useful, and I've actually picked a few new things as well. Thank you very much. Really appreciate it. And we'll get asked a lot of the times about that 6 years rule.
Yeah, I get that asked a lot as well. So 6-year rules, and also if there's the market valuation, that could be a good, tax saving strategy towards capital gains tax. So if it's been more than 6 years, definitely try to get the market revaluation done for your properties for sure.
100%.
Yeah.
All right. Thank you very much, everyone. And you'll get an email with all the information, and we'll send everything across as lovely calculation tools as well. But if you have any questions, you can always reach out to Loveleen directly, H2O people as well for any finance needs, and NIDUS Group as your selling or buying partner, always there to help. Anything else?
No, nothing else for me. Thank you so much for your time. Sorry, I was rushing in the end. I was just very conscious about the time. But if anybody has any questions, more than happy to answer. Just shoot me an email or just give me a call and we can arrange a time to basically speak further.
No problem. Thank you again.
Thanks again, Farhan.
All right.
Thanks,
Good night,
everyone.
everyone. Thank you.